And now to introduce our two wonderful presenters today. Ali Oromchian, JD, LL.M, is a leading legal authority in dental law and the founding attorney of Dental and Medical Council, PC, with over 2 decades of experience. His deep connection to dentistry comes from his wife's nearly 2-decade-long career as a pediatric dentist. This personal insight fuels his dedication to empowering dentists to navigate their legal challenges and achieve their practice goals. In doing so, Ali has helped thousands of doctors open their practices while maintaining legal compliance. Ali is frequently quoted and contributes articles to dental publications, including the California Dental Association, Progressive Dentist, Progressive Orthodontist, Dentistry Today, and Dental Town. And our second presenter tonight is Gavin. Shea is recognized and trusted healthcare industry leader with more than 2 decades of experience guiding clients through practice transitions, startups, and growth, with a specific focus on practice transition financing. Gavin brings a balanced and unique perspective of the vital stakeholders that contribute to a successful transition. This experience empowers practice owners to navigate their transitions with ease, confidence, and foresight, ensuring they rise above challenges and seize opportunities. Welcome, Ali and Gavin.
All right, good evening, everybody. Thanks for being here. Hopefully you got food out there. So we'll try and get this started and make the most of our time together. I'm just looking for that little clicker. It's kind of dark in here, but we found it. So I appreciate the introduction. Thank you for the opportunity. Just like pulling back the covers a little bit of my background. I spent about 25 years of my career, started out with a company called Matsko. I don't know if some of you remember that here. Back in 1999, some of you might have started up or financed your practice acquisitions back then. I might have been the person that did the paperwork on those loans 25 years ago. But I spent most of my career running and leading that group for about 15 years, whether it was Matsko or Wells Fargo. And most of what we did during that time is we probably see about 500-600 practice transitions across the country every year. And being responsible for the portfolio and the different transactions and managing the risk, I saw almost all of them. Unfortunately, because of my leadership role, I probably saw the ones that did not go so well more than I saw the ones that did go well. But over time, I just accumulated a lot of insight, a lot of knowledge. And the time came in my career where I wanted to make a pivot. And I decided that, the skills and the information that I built on the financing side and transitions can really add a lot of value to the seller side and helping them work through those moments. So much of my career was working with buyers, doing this for the very first time, and poured a lot of energy into coaching and educating them. But even though that you have been practicing for 20, 30 years, some of you maybe longer, you're selling your practice for the first time. And so walking into that moment and helping you kind of understand what some of the challenges and obstacles are in advance that will come up and prepare you for those is really what my mission in my organization when I founded Revolve Practice Transitions is all about. So when I'm talking to you tonight, I just want you to know that I'm not here to sell your practice. I'm here to help you understand how to effectively transition it regardless of what your plan is. So when you think of questions, details, I'm an open book. Just fire away. If I can dispense some advice and help you work out some unique situations, we'll do that together. But when we think about transitions, depending on where we are, and I'm going to see if this clicker works, but one of the things I realized about the moment of transitions, there's probably 4 things that I kind of keep in mind at any given time. These are just characteristics that I think I need to possess. And I'm going to share these with you because they go on the seller side as well. Number 1 is really just to communicate, right? This is a highly personal, engaged transition. you're kind of the center of it. Communicating your needs, desires, wants to those that are helping you out is number one. And that's partly my job as being a partner. Two is being organized. Really, some of these transitions can move pretty quick. Other people are involved and having that content, ready to go. Third is managing timelines. So once we kind of set things in motion, understanding how long certain things take, getting back to the idea is everybody's doing this for the first time between the buyer and the seller. So sometimes when they have an insurance requirement, they don't necessarily understand how long it takes to get those in place. Really kind of managing those timelines is key. And then the last, and I would say probably the most important characteristic, is to stay calm. And, I've learned that through a lot of challenges because there's always going to be something that comes up. There really isn't a perfect transition process. There are things that are going to arise between the buyer and the seller that they just happen. Right in the middle of the transition, we had this happen not that long ago. A 17-year, very trusted, reliant office manager broke her ankle, required surgery, and she is gone from the practice. And that was the one person that was going to effectively transition with the buyer. And the seller called me and was somewhat distraught about it. I said, well, here we are. It happened. We'll work through this together. And I think just knowing something that's going to come up, that's going to be a challenge, I think is probably, the one piece of advice that I can give you is just the Murphy's Law definitely comes into play. Let me see if I can get all this. That works in there. All right, so the number one and the first obstacle that we're going to come across that we need to talk about today, we're going to talk about 4. And it's in this room, and it's you as the seller. And I'm not trying to be offensive. I'm not trying to really, pull that card off your face, but this is really the first obstacle that you are going to come across as a seller contemplating their transition. And what I find when I talk to curious sellers is, well, let me ask you this question. How many of you would say you're about maybe 2 to 3 years away from retirement? That is the most common response. If I were to ask you 6 months from now, how many of you are 2 to 3 years away from retirement, I'm pretty sure the same hands are going to go up and maybe a few more. Eventually, this whole room will be 2 to 3 years away from retirement. It sounds close enough where you should start coming to events like this, but far enough away that you don't necessarily really have to start doing the things that are going to set that wheel in motion. These are the questions that generally hold you up and make it difficult to change that 2 to 3 years to something like the end of this year. And these are questions that many of you are asking now is, can I afford to retire? What will I do when I retire? Right? And that is hard to respond to because they're very vague, general questions that most of us, when we're lying awake at night at 10 o'clock thinking about the next day, don't necessarily have the ability to specifically answer at that time. The alarm clock goes off the next day, the schedule takes over, you finish the day, it's wonderful, and then these questions pop back up at the end of the day. So as we think about this, it's changing the questions and being more quantifiable and more insightful with the responses that you have. And on the left, we've got the financial aspect. So instead of, can I afford to retire? If you haven't done this already, you should know how much income you're going to need each year when you retire. That would be the first question to answer, which will then feed into the second question. I think we're working right now, so perfect. Which is going to feed into the second question, which is how much do I need to have saved in order to have that income during retirement? At this point, it is a math equation. And that is a math equation that you and your financial planner should have when you're thinking that you might be a few years away from retirement. Once those numbers match up, you're in pretty good shape from a financial standpoint. Then the rest of the time that you work is maybe adding to that pile a little bit. You're doing it for fulfillment reasons, but I would highly urge all of my clients to really have a good idea of what those two answers are on the left side of that page. What's on the right, this is a little bit harder, and this is on the personal side. And this is, do I want to keep working after I sell my practice? You know, not every version of retirement means that you have to stop being a dentist. You could potentially retire from being an owner. You could work as a dentist part-time. You can become faculty at UOP. There's lots of different options that you might have available to you that resemble, you know, working, not necessarily retiring. So it doesn't have to be a zero-sum game in exiting dentistry. And I'm going to come back to that one in just a minute, because it's, you know, how long do you want to keep working, right? That's another thing that you want to take ownership of. And the reason that that's important is if I'm representing you, there's two things that I'm really acutely advocating for when we go to sell your practice. One is the purchase price. The other is, what do you want to do after you sell your practice? So you say, Gavin, once I sell it, I might want to stick around for 30 days and then I am off to my home in Montana and I never want to come back. Well, I have to advocate for that and look for the certain type of buyer that's going to be able to support that kind of transition plan, because my job is to get you where you want to go next, not just simply sell your practice. So when you have a really good idea of how long you want to keep working, and if you do want to continue practicing dentistry, that's part of the component that goes into the sale. Now, the opposite part of that equation is if you say that you just want to kind of cut back and you'd like to work for another 2 to 3 years, we're going to have a conversation about how that's going to fit in with a new buyer, with the type of practice that you have and what that might look like. Again, this is just as important to maintain in this transition as the value of your purchase price. And so really having a good idea of where it is that you want to be next, how long you might want to stay working, and in what capacity, that is really, I think, one of the most important ingredients, where I also see a lot of negotiations kind of going sideways as two people have two different opinions too late in the game to kind of make that work, right? Let's be upfront about it, and have the right buyers come in and the right buyers not come in on that. If that's not working, is if you're really kind of struggling with what's next, is just simply asking yourself, if I had more time in the day, what would I do? And this might be where you talk to family and friends. And, you know, you often find, I did with my wife when COVID hit, we went work from home. I realized how much I was missing, like during the day, and how much she just didn't tell me I wasn't there for those different things. And I was like, wow, you know, I had no idea that all that stuff was going on during the day. I kind of missed out on that. So sometimes we get so wrapped up in our schedules and our days, we need some help and some assistance in finding out, you know, what is it that I could do with my free time? But if you really kind of think hard and really write down the answers for yourself on these questions, this is when you start to move from being curious about transitioning to being committed to transitioning. And that 2 to 3 year timeline becomes the end of 2024 or the end of 2026. And that is a number that's going to continually get closer, not continually reset for another 2 to 3 years. So sidebar on this, because we talked about your retirement planning, the big question in the room becomes is, well, how much is my practice worth? And you might meet with your financial planner and they might tell you what the number is, and how much is the sale of your practice going to contribute into that financial plan. Now, there's lots of rule of thumb scenarios that you can go online and you can go into the internet and take a look at. My advice on rule of thumb scenarios is that if you're really far out in the planning, where you might be 10 years or more from retirement, rule of thumb works great, because you've got a lot of time to kind of make up for any errors in that. But when you're inside of 2 to 3 years and you want to really kind of get it right, you know, having an evaluation that kind of really looks at the components of your practice is really where the next step would go to help you plan for that. So I threw up a couple of terms. Has anybody heard EBITDA kind of thrown around, SDE, seller discretionary earnings. Do these terms resonate? Seller discretionary earnings is more likely what a private party doctor-to-doctor sale is going to look at when they're valuing your practice. This is the earnings of an owner that's capable of producing the dentistry. So this is going to maybe include some adjustments where there might be family wages in the practice, other personal pension expenses. The job of a good evaluator is to identify all of those additional expenses and assess what the true profitability of your practice is, which is that seller discretionary earnings number. Most multiples of valuations are going to be based on that seller discretionary earnings figure. The cash flow that the lender is going to look at to qualify your buyer to purchase that practice is often going to be based on that number as well. You have great accountants. They do wonderful work to minimize your tax obligations, but this is the time to really kind of open up the cupboard a little bit and take a look at what the true profitability is so that you can get a handle on what that will be. And this will be one of the first questions that a potential buyer will probably ask. Does anybody hear about the term EBITDA? That gets thrown out a lot. You know, I've got a tiny little pet peeve on this one, is that I've heard EBITDA so much in a way that it's made to be so much more complicated than it really is. It almost gets thrown around by corporate buyers and other people just to make the whole process really complex of what EBITDA really is. But EBITDA is essentially spelled out as an acronym and exactly what it is. It's essentially the acronym of how to calculate the profitability of a practice, which is simply the earnings before interest, taxes, depreciation, and amortization. So if you look at your income statement, you're going to have a net income line at the bottom, and you're going to go back in, you're going to find any of these expenses in your income statement, and you're just going to add that to your net income. I'll do this a different way. EBITDA is basically just seller discretionary earnings after doctor compensation is paid for. That's really the only difference between the two. Yeah. Yeah, discretionary is a couple of things. So discretionary first represents the different forms of owner compensation that can exist in your income statement. So you'll have wages that are very clear as owner's compensation, but you may also have a pension expense for yourself. You may also have family members that don't play a relevant role in the practice that might have been paid salaries for various work that isn't essential to produce the revenue. You may have auto expenses, and if you were a delivery company, that would be an essential expense, but as a dentist, probably not. So discretionary will also apply to things that aren't necessary to actually produce the revenue of the practice. And so what a good evaluator is going to do is take a very balanced view, because you can go really hog wild on what's discretionary, and you could erode the integrity of your financial statements if you go too far. And so if you take it by just the reasonably explained expenses on your income statement that are not essential to produce the revenue or are part of your owner's compensation to produce that revenue, that's seller discretionary earnings. Does that help answer that question? Yeah. And then again, you know, EBITDA, the only difference between the SDE and the EBITDA is what EBITDA will do is we'll sign an expense for the doctor's salary to produce the revenue. So if you're a general practice, they might assign a 30%, compensation rate, and they'll deduct that from seller discretionary earnings, or that's just a shortcut way of doing it. And then you're left with EBITDA. EBITDA, like I said, EBITDA is made to be very complex and kind of secretive. It's not. It's pretty straightforward. In fact, the name itself spells out exactly what it is. But if you've ever had a seller discretionary earnings exercise done, what I just might do is, if you want to find out your EBITDA, just add a reasonable market salary for your profession, whether you're a specialist or a general dentist. And that's the number that you're left with. One little tidbit is generally you need 1 full year of that profitability for it to impact the value of your business. So if you had, $500,000 of profitability in 2023, but now you're on pace for $750,000 of profitability in 2024, you generally need to have about 12 months of that number before you can kind of reset to that new value. There are certain situations where you might be able to get by with a little bit less, but just generally speaking, if you're making any changes to your practice and you want to get the value of that increased profitability after it, you should probably have 12 months to sustain that new level before it gets applied to that. This is the earnings part. This is half of the multiple equation that's being used to value your practice. The other half is what multiplier is. And what I hear on the seller discretionary earnings is that the average practice sells for 2 times seller discretionary earnings. Well, the average is made up of thousands of practices. How do we know that your practice is above average or below average in that category? It's in the desirability. What is a buyer willing to pay for that? What is attractive to them that's going to make that multiple higher than 2 or lower than 2? The factors that come into play are just the location, which is market demand, but also financial risk. If you're in a densely populated area with an abundance of patients, the ability to maintain those revenues is high. Patient and procedure mix. Is it all Medicaid or is it all fee for service? Is it somewhere in between? These things are going to make a difference. Are they simple procedures or are they more complex? And more complex means it might be riskier for a buyer to take over. So all of these kind of factor in to the equation. And so at the end of it, you should have a true profitability figure and you should have a multiplier of that profitability figure that's based on the characteristics of your practice. And this is where you would get a formal valuation out of that exercise. And that would give you a very firm number to send to your financial planner, say, hey, I've had a formal valuation. We believe that this practice could sell for $750,000. Let's start modeling that into the retirement plan. That would be something to take a look at 2 to 3 years out. I know I ran through that. This is a place for a lot of questions, but I just want to kind of get your kind of wheels turning on that part of it. So obstacle number 2 that you're going to come across. Are there any potential buyers in the room? Okay. It's not because I'm going to talk bad about it. I'm just going to talk very candidly and very frank about it. Because, ultimately, their desire and their willingness to buy your practice is going to be your next obstacle. But understanding kind of what their mindset is and how they're looking at your practice, I think is the key to success here. And so, you've got a buyer and most of us think, well, if I'm selling my practice, my competition are other practices for sale. That's not true. Your competition with a buyer is their current job. Dentistry has an unemployment rate of 0.5%. Every single buyer out there is gainfully employed somewhere. And when their schedule is done, they go home. And then they come back the next day. They know how much they're getting paid every week, every month, every year. And as long as they do a good job, they should maintain that level of pay. Those things change as an owner. So when they walk into your practice, it's not that they're comparing your practice against other ones that they may have looked at. Is they're comparing their practice against their current job and the stability that they have. The other place that this comes in is that if you've tried to sell your practice on your own or had any experience with it, the buyer will come in Monday, you'll have a wonderful meeting, and they'll be all excited, and then you won't ever hear from them again. That's not necessarily because they didn't like the practice. That's because they're really busy as a dentist, and some of the best buyers are very, very busy. So that other job that they have will get in the way, not just in terms of them looking at your practice, but also, in terms of their timeline in moving things forward. So what can you do about that? So on the facility side, organize your office. This is one of the things I talk to my sellers all the time, is that is the one difference between them as an associate and them as an owner, is they don't have to go after their schedule into that office and deal with any of the paperwork or any of the other hiring or firing employee matters that go on there. They get to go home. And so organize the office, because if it looks nice and clean and tidy and it doesn't look like a stressful place to be, we're in good shape. If it looks like there's a whole lot of things that they got to do when they take over an owner, might be a little bit of a turnoff. Ensure all the equipment is working properly. A lot of debate goes in, do I buy new equipment? Honestly, if the chair is working, it's going to produce the same revenue regardless of the manufacturer of the chair. The buyer's probably going to have their own preferences. You won't get your money out of the investment of that chair, but you certainly want to make sure that they work. And then, repair some interior wear and tear. These are just minor touch-ups, things like that to make the office look nice. The operations side is really kind of the meat and potatoes here. If you have the opportunity to review and update your staff manual, please do. Your ability to kind of show a potential buyer all the written down procedures that you have, vacation policies, things like that, it goes a long way. Makes it really simple. Documenting key procedures, different meetings, schedules. The more that you can just kind of write down the things that happen in the practice from an owner standpoint, you've been very successful intuitively running the business. This is an opportunity to maybe document some of those things and have those ready to go, which includes, any patient recall, marketing efforts, and take a look at your practice management reports. It's amazing how many times that we run an accounts receivable report like right before the sale, and that might be the first time a seller might have seen that, and you have a whole lot of balances that haven't been written off for the last 5 years, and it just kind of becomes a lot of a cleanup effort at that point. So again, these are just little things that you can do. But I have this little call out here on the bottom, talk to my staff, okay, with a big question mark. These are the things, if you're not ready to talk to your staff, you have to be careful about. Because if you start painting the walls, updating the procedures, getting everything ready for somebody else, they're kind of going to get an idea that maybe a new owner is coming in soon. And what I would say about talking to your staff, people ask me, when's a good time to talk to your staff? It's different for everybody, and it's different based on their staff, because there's risks involved in that. One of the things that I generally follow is that nobody really likes incomplete information. And when they get incomplete information, they usually kind of fill in the blanks with worst case scenario. So here's some example of incomplete information. I'm thinking about selling my practice. You don't know when, you don't know who, you don't know what's going on, right? That's probably not a good time. There's a time when you find a buyer, and now at least you know who the buyer might be, but maybe that buyer could fall through and they don't successfully complete the transition. There's due diligence when the buyer is completed and now they're committed and the deposit is made. Now we're a little bit closer. If you're thinking about the risk of telling your staff, it's probably somewhere between identifying the buyer and the day you close the deal. And where you sit in that, period, a lot of it depends on the relationship you have with your staff, the commitment that the buyer has. I think somewhere in that window, and waiting to the very last minute is probably not the best idea, but that just gives you an idea of just some of the different timetables that are out there. But be careful when you start doing this. Don't do it all at once. Do it little bit pieces at a time. Do it after hours. Don't make a big deal. The obstacle number 3, no offense to our friends in the back, is the bank. They're not really an obstacle. They're here as our friends. But there may be some things that the bank starts to ask questions about at this stage of the transaction that you may not have addressed up until this point. There may be some questions that the buyer get asked that kind of spooks them a little bit, right? This is where some of the delays come in and getting the information. And so when you're looking at the bank, the best thing to do is have the required info ready to go. So this is going to be the last 2 years of your business tax returns, generally speaking, along with year-to-date financials within the last 3 months. That's a good rule of thumb. So at this point, if you had through the end of March or April in 2024, that's probably a good number to have. If you have your tax returns on extension for 2023, that's fine. Just add 1 more year of a tax return and have that copy of that extension ready to go, and the income statement for that period of time. The office lease, have that ready to go and take a look at that. And we'll talk about that one in a minute. The potential info, remember when I was getting back to those seller discretionary expenses and explaining some of the financials, this is where having some backup to that goes. So if you do have family members, having the W-2 statements for those employees. Maybe you employed an associate 2 years ago that hasn't been with the practice, bless you, but you want to have that income kind of taken a look at in the analysis. Have those W-2 statements ready to go. And any existing loan payoffs. You should have this on your balance sheet, but having an idea of what debt that you're going to need to have paid off during that period of time, that's going to be an important document to have ready to go. Hopefully your accountant has that for you. And that's where your CPA is going to come in at that point, making sure that they have everything nice and tidy for you. So the biggest obstacle, and unfortunately, this usually comes up towards the end. So we've got a buyer, we've got a purchase price, everything's been negotiated, and it's time to get the landlord to sign a new lease to the buyer. And this is where we're going to run into a couple of things, and I outlined here what you should have in place. So number one is, what's the remaining term of your lease? If you have less than 5 years left on your lease, you're probably going to need more for that buyer. If you have a 5-year term and a renewal option, that's fine. But if you have just a 2-year term and that's it, that's something that will need to be addressed in the negotiation with the landlord. And is my lease assignable? If you have a good attorney, hopefully it was written that way where you can assign it to somebody, but we're going to want to take a look at this because we don't want you to be responsible for the buyer and their lease after the fact. We want to make sure that you can freely assign this. And so rule of thumb would be to have a term plus renewal option in the 5 to 10 year range. Now, if you don't have that and you're in a position where you have to renegotiate the lease, I have no advice for you on this other than call your attorney. So, and the good news is Ali's going to follow me after this presentation. So we'll be in good shape on that. There's a lot of things to consider if you're currently in your practice. Is renegotiating the lease the right thing for you to do? Or is it something that we want to just do when we get the buyer on board and we renegotiate it on the buyer's behalf in order to close the deal? These are things that we just kind of have to take a look at based on what you have available. But that's why getting your lease at this stage is going to be an important ingredient. And then, finally, I know I ran through a lot of information here, but I think the thing to just think about is that, this is a change for you. And it's going to take some time and some thoughtful process. And it's okay to not have everything figured out, as long as you kind of know who it is that's going to be on your team and you can ask them the right questions. But also the change is going to occur throughout the process. The buyer may ask for different things and you may feel a little uncomfortable about it. But just kind of knowing that it's going to be different and it's going to be, maybe even a little emotional, it's fine. Because 99.9% of the people that go through this encounter those things, and they kind of go in and they go out and they go back and forth, and that's okay. You're entitled to that. You've worked a long time. This is a big moment, and you should take your time. And so, I'm looking forward to kind of being a partner for you to just give you advice and some insight. I ran through a lot of stuff, so hopefully I gave you some ideas and some thoughts and stimulated. I saw some good notes. So let me know any immediate questions before we kind of turn over to Ali.
Those of us that might be 5+ years out.
Yeah. Mm-hmm. Mm-hmm.
I recall way back, I was looking by my term practice.
Yes and no. Production is a good barometer and a good measure, but if you have $1 million in production but $200,000 in discretionary earnings versus $800,000 in production and $400,000 in discretionary earnings, that practice with 400 is going to be more valuable because at the end of the day, that's what they're taking home, right? Where production comes into play is just understanding a little bit of the potential of the practice and some other things. It helps you size the buyer market a little bit. But I would caution about using production as just a simple measure of evaluation, because that's also where things get caught up on the bank side. So you may think that, 70% of production is a good valuation figure, but if the profitability of the practice is really low, the loan could get declined. Whereas a smaller practice with higher profitability would get approved. So it's a little bit of, it's a partly accurate, but it's a little bit misleading and a little bit too simplistic. The one thing I would say is maintaining production, maintaining profitability is key. And it's not a matter of you declining and then finding a lower price to sell your practice. You could actually get to a point where your production declines so much that the desirability drops to zero because the market demand is not there as a buyer. So maintaining that level of production and profitability is key as you're thinking about phasing out. Because again, it's not just devaluing the practice, it could just shrink the buyer pool to almost nothing, because it's expensive to live in the Bay Area. So if the practice is only producing $150,000 of income, it's really hard for an individual doctor to afford that. Yeah, good question. Yeah. Oh, yeah. I almost did that and I started looking at the clock. I'm like, oh my gosh, we can do a whole seminar on that. So Delta is a challenging moment. And I'll tell you how I work through it with my clients is we'll identify the percentage of Delta. So if you have 50% of your production in Delta Premier, we know that the buyer is not going to be able to produce that at those rates. So what I'll do is I'll take a look at what the value of that change is going to be. A lot of buyers, a lot of other lenders, the discount could be as high as 30%. So if we have $1 million in production, 500,000 of that is Delta, and there's going to be a 30% drop, which could drop the purchase price by as much as $100,000. So what I do with my sellers, I said, listen, I'm not saying we drop our purchase price. We'll market it at this level, but let's be prepared for buyers to come in and want to buy it for, let's say, $650 instead of $750. And what we're going to do is we're going to send them an insurance utilization report. We're going to show them exactly how much Delta Premier is in your collections. We're going to send them your fee schedule against those records. And I'm going to ask them to compare that fee schedule to what their fee schedule would be, calculate the difference, and come back to us with some number that they think they want to make an offer around. And more likely than not, it's going to be somewhere between that worst case scenario and the purchase price that we talked about. It is a very real discount that buyers are asking about. If you have referred out services, let's say you don't do any endodontics at all in your practice, then we can bring up things like that with the procedure report, saying, okay, I know Delta is going to drop, but all of this endo is being referred out. Do you do any endo? Because you can bring in, another $20,000, $30,000, for that. So we'll have to talk about that. It's definitely part of the discussion. But really, really good question. Yeah. Anything else? All right. Well, without further ado, and you can scan that QR code, we can have an individual conversation if you'd like. I want to introduce Ali Oromchian. He's somebody that I've known for probably 20 plus years now. And I think, when I think about calling an attorney, I think about Ali.
Yeah.
So
To get you out of jail.
Yeah.
Get you out of jail.
Hopefully not.
All right. Well, welcome everyone. And there's a lot of information that Gavin shared with you, and some of it, I know for some of you, it might be the first time you're hearing of this, and it's that's the process, right? The process is to kind of keep hearing this material as you navigate this journey that you're on to go from a practicing dentist to one that's getting ready to retire, right? And ready to move on to the next stage. And and one of the things that I've really enjoyed working with Gavin on the practices that he's sold, whether we're representing the buyer or the seller, is that his focus on the financial strategies and the financial framework that he presents your practice to a buyer. Because a lot of it, as you know, comes down to those negotiations, like the delta issue, right? How do you handle the delta issue? Some brokers will just discount it because that's what, the buyers, want, and get the deal done. But if you handle it more strategically, then you can get more for your practice and keep the relationship strong with the seller. And I guess that's the point of tonight. The point of tonight is to talk about the different strategies that you can implement as you're getting ready to sell your practice. What are the things to think about as you're getting ready to sell the practice? And this is a very interesting time in our country because, of course, it's been 4 years since COVID, and we're trying to, forget about COVID, and we've all kind of time traveled for 4 years. COVID happened, and then we wake up and, it's 2024, and we don't know what happened in between. But something has happened that I didn't think was going to happen, if you had asked me 5, 6, 7 years ago, which is the tide has turned. For about, when I started my career about 20 years ago, working really only for dentists, it was a buyer's market. It was a buyer's market. And then the tide turned. After the dot-com crashes and the financial crisis, the tide turned, and there were a lot more buyers than there were sellers. And so it was a seller's market for about 15 years or so. That has changed now, right? That has changed. It is now today a buyer's market when you're selling your practice. It's a buyer's market. It's not a seller's market anymore. There are more sellers than there are buyers. Okay? Now, does that mean you're going to have a hard time selling your practice? No, not necessarily. Why? Because you're in the Bay Area. And you're lucky to be here because people want to be here. They want to live here, right? If you're in, and I'm not picking on Idaho, but if you're in Idaho, right, you're having a hard time because it's not 2021 anymore, and people are not enamored by the great Wild West that is Idaho. They've spent a couple winters there, and they're like, holy cow, there's a real snow here. I have to plow snow twice a day. I'm going to move back, right? But it is a buyer's market. So you have to be ready for that. And we're going to talk about that tonight because when it comes to, when it's a buyer's market, what it means is that you've got to be extra vigilant, extra strategic to be able to not only transition your practice well, but to get the price you want and to find the right buyer that's not going to cause you troubles after you sell, right? After you sell. So it's really important to kind of keep that in mind. You guys know I've been, providing seminars here for years now, so you guys know all about me. But we're going to talk about these things before we end today. We're going to talk about some basics. We're going to talk about human resources, due diligence, lease considerations, DSOs at the end, and then some mistakes to avoid as well. So let's talk about the decision. The decision, there really isn't a bad decision, except if you don't make a decision about what you want to do about your practice. And Gavin kind of talked about this a little bit, but the worst thing you can do in your practice when you're getting ready to sell is not worrying about the size, right? Some of you have practices where you're doing $300,000, $400,000, $500,000. Some of you have practices that are doing $1 million. Some of you have practices that are doing $1.5 million, $2 million plus. And you know what? Every single one of them will sell. Every single one of them will sell. Why? Because there are buyers out there who want a small practice to grow into a big practice, right? There are lots of them out there. There are a lot of buyers who want to buy a comfortable $800, $900 million practice because they know that they can do that dentistry. And then there are some buyers who want the big stuff because they feel like they're ready. They're working somewhere where they've done a lot of dentistry. So all of you will be able to sell. Those of you who wait, however, and let your production fall, right? whether it's intentional because you're taking a lot more vacation and time off, or if it's unintentional, God forbid, you get sick or there's a disability or something, those practices are harder to sell, right? Not because you have a bad practice, but because the banks are going to look at it and say, what is the problem with this practice? Why is it falling in revenue, right? And you don't want that. You want practices to be flat. Flat is good. Or slightly up, okay? You don't want really up because the banks are going to say the same thing. What happened, right? Why is it shooting up? And you definitely don't want it to go down, especially in consecutive years, right? In consecutive years. So let's jump into the world of the contracts that you're going to face. So you're going to see really these 5 contracts in your future when you're getting ready to sell. The first is the letter of intent, and this is probably one of the most important documents right off the bat that you're going to get. This is the document that a buyer will give you when they're ready to buy your practice. It's an offer to purchase your practice. Now, a lot of people will just take that and sign it and move on, right? We'll deal with the details later, but that's a mistake. You want to make sure you negotiate the letter of intent as much as or as little as you want, but you want to make sure you're comfortable with every term that's on there. The price, if they want you to work back, how long you're going to work back, how much they're going to pay you to work back, right? All of these things are things that you need to have in the letter of intent so that you're comfortable. Are you selling the accounts receivable? Are you keeping the accounts receivable? What's the covenant not to compete, which we'll talk about later? All the details. Don't let those things wait for later. Negotiate them up front so that everyone's on the same page, right? Everyone's on the same page. Everyone's happy. Then we take those terms and we put it into the asset purchase agreement. This is the main document that your lawyer will prepare for the buyer, right? So it's your responsibility as the seller to prepare the legal documents for the buyer. So if I'm representing you, I'm preparing those documents for you. If I'm representing the buyer, then you will give me those documents and I will review those for the buyer, okay? So we spent a lot of time on the asset purchase agreement. The next thing is the exhibits to the asset purchase agreement. Now, here's where I want you to take some notes because sellers make this mistake all the time. There are, in essence, 4 important exhibits that every contract will have. And you guys need to be ready for these, okay? The first is a list of the equipment you're going to sell, okay? List of all the equipment you're going to sell. Now, I don't need to see that you have 1,000 gauzes in your cabinets, but I want to see every piece of large equipment, handpiece, loops, CAD/CAM machine, lasers, you name it, it's got to be there, right? It's got to be there. You want them to know what you're selling. The second exhibit is what you're not selling. What are some things that you're not going to sell with your practice? Are you going to sell a dental chair? Yes. What are you not going to sell? Some artwork. Yeah, some artwork that is unique to you. You bought it. You painted it yourself. Absolutely. Memorabilia, right? You've got a Joe Montana jersey on the wall. Your dead body, you're selling that, right? Right? Yeah, right? You're taking it down and you're shipping it to your favorite attorney. So, all right. What are some other things you're not selling?
Maybe your favorite stool sat in forever. I don't know.
Yeah, maybe. Yeah. Maybe your favorite stool. Maybe you have loops from dental school that you still kept, right? Yeah. What else, guys? What's that? No, you're going to sell your patients because you want to sell your patients so you get maximum value. Your diplomas, right? You don't want to sell your diplomas. I'm embarrassed to say I represented a doctor who refused to give the seller his diplomas because the seller didn't have diplomas listed on their second exhibit where they're not going to sell the assets. I literally had to ask my client, are you not a dentist? Like, do you not have your own diplomas? Why do you want the seller's diploma? right? Right? He's like, well, it wasn't on the list. I was like, yeah, well, his children were on the list either, but like, that doesn't mean you get them. Like, I mean, after months of negotiation, we got the seller his diplomas, right? I mean, it was the only time I think in my career where I was actually fighting with my own client to give to the buyer, to the seller, something that, you know, they deserve. I mean, it was crazy. It was crazy. But my point is, you got to list all the things that you don't want, like to sell, right? Knickknacks in the office, memorabilia, all of that stuff. So that's the second exhibit. The third exhibit is a list of the employees, their compensation, their benefits, you know, how much they're earning per hour, how many hours they work a week. You got to list all that. Okay. The fourth exhibit. Oh, I'm sorry. I'll come stand here so you don't have to. Guys, I like to walk around and they're videoing it, so I'll just stand here uncomfortably. Just kidding. The fourth exhibit is super important for you as a seller, right? Super important for you as a seller. It's called continuing contracts. Okay, so what are continuing contracts? Continuing contracts are contracts that you sign as a business owner because you're operating your business. You hire a marketing company, you pay them a couple $100s a month. You hire HR for Health. Many of you have HR for Health. You pay them a couple $100 a month for your HR. You hire an OSHA person maybe once a year. You know, all the expenses that you have. Maybe you have a Comcast bill or Comcast contract for a year. Any contract that you have with a company while you are in business, you need to list on this. Why? Because if you don't list it in this continuing contract, the buyer is not responsible to take it over. So do you need a website company after you've sold your practice? Of course not. But you could be responsible for the rest of that term to pay a couple $100 a month. Right? Do you see where I'm going with this? Really important to work on this early on. So as soon as you hire Gavin and you say, okay, Gavin, you know, I'm going to sign your listing agreement, sell my practice, you should start to make this list because you know it's going to come down. It's going to happen sooner rather than later, right? And what the worst thing is to wait at the very end of a deal when the negotiations are happening and people are waiting for signatures for you to make this list because, as you can imagine, it's a pretty stressful time, right? And so people forget to, you know, to list all these things. Yes?
What do you do with your like federal payroll tax if you have a federal tax number and also you have a state tax number?
Those
They transfer to the new buyer, or do you have to end those and they have to take their own account?
Yeah, great question. So the question was, what do you do with your federal ID number, your federal tax number, your state tax ID that ties to payroll? If you sell your assets of your practice, which is like 95% of the transactions we do, you keep all of that, the buyer has to set up their own. If you are lucky and you sell your corporation as stock, because the buyer knows no better and has no counsel and just woke up from a deep coma, right? Then all of those things transfer with your corporation, okay? But 95% of all of our deals are asset deals, not stock deals. So you keep all of that. The buyer sets up their own. And then once you're done and the deal's done and there's no other reason to keep your corporation alive, you close your corporation and all those things go away. Good question. Okay, next thing is the lease assignment. So you got to get a lease assignment from the landlord so the buyer can take over the lease. If you own your own building, please give the buyer a new lease, of course, which you know it's smart to do. But I want to give you a pro tip here because San Mateo County, Santa Clara County are really in a really kind of a weird place right now. So what's happening, even during this crazy time in the economy, these technology companies are secretly, and sometimes not so secretly, buying all the real estate that they can in in San Mateo and Santa Clara County. And what they're doing is they're buying all this real estate through all these like hidden LLCs and things, and they're doing it so they can either rebuild, right, and build housing for their employees, or sometimes they use it for their corporate campuses. But what's happening is that landlords who are being approached by these companies understand what they're sitting on. So what's happening is if you're in like a small dental medical building, or you're in a strip mall or some other kind of location, and it's starting to age a little bit, a lot of landlords right now are not renewing leases, right? Are not renewing leases. And if you sell your practice, a lot of landlords are not giving long-term leases to buyers because they're getting ready to redevelop, right? So you've got to be really careful. This is another thing where you, just today, I mean, literally today, I had a call with opposing counsel. I was representing a seller in this area, and the seller, the attorney for the buyer said, my guy just talked to the landlord, and the landlord said, there's only 2 years left on the current lease. He will give another 3 years, but he will not give anything beyond that. Do you think buyers are going to buy a practice for a 5-year lease in this county where real estate is impossible to find? Not when they have a 15-year loan, right? So my point is, you got to start acting a little bit earlier. If you have a 2-year time frame and you're here today, you need to start talking to Gavin now. You need to start planning now, because there are situations where if you don't plan ahead, right, you could be left like this gentleman, where he's selling his practice, but he can't because the landlord won't play ball with the buyer. So we have to find a strategy, right? We have to find another strategy. So you don't want to be in that boat, because that's when things start to change, because your mindset's already ready to sell, right? So be careful with lease assignments, especially right now in San Mateo and Santa Clara County. And then associate agreement, if you're planning on working back for the buyer, then you want to get an associate agreement. If you don't get an associate agreement, it's not the end of the world for you, because associate agreements are meant to protect whom? The employer, right? Rarely do they really help the employees. And so if you, as the future employee, don't get an employment agreement, don't lose sleep over it. But if you do get one from an employer, from a buyer, because we're working with them, which we will make sure they give you one, they just don't be offended, right? You're going to get one from them. Okay. Next thing is restricted covenant. How many of you have heard about the new FTC rule that came down, the Federal Trade Commission? Okay, perfect. Yeah, almost all of you. So that does not apply to California. Okay, so just so you know, okay? So you can ignore everything you read about that. We are already way beyond that rule, right? Like the federal government is trying to catch up. California is like that was like 20 years ago, right? Like we are well down that road. It's been compared to slavery here. I mean, that's how far we are down that road. So it will never change here, right? They passed that rule for the 49 other states that have like cockamamie rules. So that doesn't apply. That does not apply here. More importantly, it definitely does not apply when you're selling a practice. Okay, it's only meant, that rule and the California version of that rule is only meant for associates, for employees. It's not meant when you're buying and selling businesses, okay, which is what you're doing when you're selling your practice. So a buyer can hold you to a covenant not to compete once you sell your practice. And when you think about it, it makes sense, right? We don't want people to sell businesses and then walk down the street and open up a practice. I mean, what's going to happen, right? All the patients are going to follow. So it makes sense, and it's reasonable. Expect a 5-year term. Okay, so you can't compete with them for 5 years. Usually a minimum of 10 to 25 miles. Okay, 10 to 25 miles is usually the range. If you're in San Francisco, it'll probably be like 5 to 7 miles. If you're here in anywhere in the county, it'll probably be anywhere from 15 to 25 months, right? And the reason is because, I mean, east and west, you're in the ocean, so that doesn't count, right? You're really just worried about the north and south portions. And the reality is that patients travel. So just expect, something in the range of 15 to 25 months, okay? And that's very normal to have, okay? But remember, the rule does not apply in California, but especially does not apply to this buying and selling of offices, okay? Any questions about that? Okay, good. Okay, allocation of the purchase price, hugely important for all of you because it impacts your taxes. So when you sell a practice, you and the buyer have to notify the IRS about how the purchase price is divided amongst two classes of assets. One class is called tangible equipment or tangible assets, I should say, which includes equipment, supplies, tangible stuff that you can put your hands on, okay? The second class of assets is called intangible assets. That's stuff that you cannot put your hands on. Goodwill, covenant not to compete, things that are not tangible. So tangible, intangible, right? So the IRS wants to know if you sold a practice for $500,000, how much of that is tangible and how much of that is intangible, okay? Now, the more money you allocate to intangible, the better it is for you tax-wise because you pay 20% tax on that, long-term capital gains, okay? Right? That's the best. If you, the amount that you allocate to tangible, right, tangible, gets taxed at your ordinary tax rate, okay? So if you're in the top tax bracket, it'll probably be 35 to 40%, okay? I'm excluding the state stuff because that's just on top of all that. But we're talking 40, just on the federal level, 40% and 20%. So pretty big difference, right? Pretty big difference. So you want as much as you can on intangible, okay? On intangible. The average ratio is 80-20. 80% of the purchase price goes to intangible, the better tax rate, 20% to tangible, 80-20, 80-20. That's the average. You can go as aggressive as 90-10. 90% intangible, 10% tangible, okay? Now, at some point, your financial advisors, your CPA, someone will give you really bad advice, okay? They're going to say, I don't know what you're talking about. 80-20? No. We want to save you even more. Let's go 100% intangible. Or 99% intangible, 1% tangible. I'm so smart. I just saved you a lot of money. Let me manage all your funds. Right? Do you guys see a problem with that? What's the problem with that? Who gets screwed in that situation?
Red flag.
The government, not the buyer. The buyer doesn't really care, actually. They get to deduct the whole thing the entire time, no matter what. It's a little bit slower, but they get to deduct every penny. It's the government. So if you want a really painful rectal exam in retirement, right? And you want to get audited by the IRS, please go more than 90-10 on the allocation, right? In my 20 years, I've only had 2 clients be audited when they've sold their practice. And both times they went more aggressive than 90-10. Now, is that scientific? No. But you know what? It's 2 out of 7,000 transactions, right? It's the only thing I can think of that got them audited there. So do not go more aggressive than 90-10. In fact, just go 89-11, right? Just in case you forget to carry the 1 or something. And then You just do not want to be on the other side of that, right? So remember, no more than 90-10. Ideally, if you want to be super safe, 80-20, right? 80-20. Because if they audit you, they're not just looking at that. They're going back 3 to 7 years. Okay? So they're auditing a lot of years, right? So you do not want to be audited in retirement, especially when you've retired, you don't have money coming in, and you still have to pay the IRS, if they find stuff. So just kind of keep that in mind. Okay, accounts receivable. Any orthodontists in the room? One orthodontist? Okay, so accounts receivable are monies that are owed to you from patients when treatment is finished. Okay, treatment is finished. Okay, so you've got to decide are you gonna keep the accounts receivable and let the buyer collect for you, or are you gonna sell the accounts receivable to the buyer? Okay, so if you sell it to the buyer, let's say you have $100,000 of accounts receivables, you have to give a discount for what you're selling. So you might sell it for $60,000, $70,000, $80,000, right? A pretty significant discount. If you decide to have the buyer collect it for you, they will usually collect it for 3 to 6 months, and then you pay them 5% of whatever they collect for, to cover the cost of postage and employees and stamps and all that kind of stuff. Okay? Does that make sense? Okay. So you got to decide, do you sell at a discount, or do you collect, or ask them to collect for you? One pro tip for you sellers in the room, which is everyone, of course, make sure you order enough letterhead and envelopes so that if you're sending paper statements, it's going out with your name. Why? Because buyers, we have seen, don't pay the nude guy, but they will not stiff you, right? So if you keep sending it under your letterhead, even though they're sending it, they're gonna pay you because they're like, oh no, we love our doctor, But if it goes out under the new guy's name, even if your name is like somewhere on there, they'll be slow to pay, right? Really slow to pay. Yes.
You check their collection.
You have audit rights. So every week or 2 weeks, you have rights to go in and look at the accounting and whatnot. Another reason, by the way, to be really nice to your bill collector towards the end of your practice, right? Because they're going to be the ones collecting for you. So start getting them chocolates and things. It works. In ortho, there's a difference between accounts receivable and contract receivables, right? Contract receivables, of course, are the monies that patients pay for their ortho over time. That is sold with the practice as an asset. So people sometimes get that confused, but that is an asset that sells. You have some contract receivables, but usually very little. Right? Usually very little. So just kind of keep that in mind. Okay. So important. All right. Human resources. The number one threat to you in retirement is not malpractice. It's actually your employees coming back and suing you because they have 3 to 4 years to come back and sue you after you have sold your practice. And the reason is because at the time of sale, you have to fire all the employees, and then the buyer has to hire them all back on. So it's really important that you fix your HR house as you're getting ready to retire, and then let the buyer kind of take over from there, because it's very painful, right? It's 1 to 2 times their annual salary is the average settlement for an employee. So if you think about that, right? If you're paying someone $25 an hour, which is about $50,000 a year, their average settlement will be between 50 to 100. And that's one employee, right? Usually when one employee sues a seller, the others follow suit, right? Because again, they have nothing to lose. You're no longer their employer, right? And so you have to be very careful about this, because it's really hard. If you've made some mistakes with one, you've usually made those same mistakes with everyone. And that's where the problems really start to accumulate, because you're not working anymore, you don't have income coming in, and now you're spending 50 to 100K, in my example, per employee. You guys may have read the famous case that we were involved with, before COVID, that was in the CDA journal, with a Sacramento doctor who sold his practice, got sued by 8 employees in a row, 8, almost everyone, and had to, in retirement, go open up a new office because it ate up so much of his retirement nest egg, right? It's crazy. It was crazy. And the craziest part is that in depositions that I personally took, because it was very near and dear to my heart, I would ask these employees like what they thought of the doctor and the family. They had nothing but nice things to say. Nothing but nice things to say. Oh, they bought strollers for my daughter when she got pregnant. They were so nice to us. They took us to Hawaii when the ADA was, I mean, nothing but nice things. But at the end of the day, their point was they retired and I can't retire, so I want my due, right? And that's what happened, right? Yes.
What would their claim be?
So their main claims are always almost the same. Wage and hour, which is I didn't get my lunches at the right time. I didn't get my overtime. Hygienists are the biggest culprits. If you guys are not paying your hygienist overtime, don't raise your hand because I know it's almost all of you. Be very careful, right? Be very careful. Not paying your hygienist overtime is a big no-no, right? And they come after you hard because they are high income earners, right? They're making $400, $500, $600, $700 a day. So not paying overtime, lunches, breaks are usually the biggest culprits, right? Usually the biggest culprits. And then we get the secondary stuff, which is, I was discriminated against, or I didn't get my paid sick leave on time or at all, all these other like violations. But it always starts with wage and hour, right? With wage and hour, right? So again, really important. Now there's a very important date coming up, July 1st. July 1st is when you get to do something very unique with TDIC. For those of you who are TDIC insurance members, there is one opportunity every year where you get to add something called EPLI, Employment Practices Litigation Insurance. It's insurance that you can get through TDIC that will cover you for not all employment lawsuits, but a lot of employment lawsuits. Okay, it doesn't cover for some of these wage and hour stuff like the overtime because it's so frequent, but it covers everything else. So it's very cheap. You can get up to, I think, $100,000 for like $600 a year, right? It's like the cheapest insurance you can buy. I highly recommend that you guys contact TDIC as soon as you can and make sure that they tell you exactly when you can add it. You may even be able to add it now because we're already in June, but it won't go effective until July 1st. This is a really important insurance for you to have in retirement because if, God forbid, you do get sued and you call me and you say, Ali, I need you to defend me, then at least you have that money that I can use to try to settle the case and whatnot. Okay? Right? Yes?
When you do retire, do you have to keep paying that premium or do you pay
No.
policy to send you out?
Yeah, great question. No, I think you only pay it until you retire and then it's in effect, afterwards. Yeah.
Maybe slightly off topic, but you mentioned overtime related lawsuits. If you're using, let's say, a time clock online with ADP or another payroll company, everybody punches in and punches out, is that pretty much sufficient protection against, let's say, claims of not getting paid sufficient?
No, because if they go into overtime into 8 hours, you haven't paid it, you're still liable, right? The problem with these payroll companies is that they're not HR companies, right? Like HR for Health is an HR company that keeps you HR compliant. Payroll companies are not HR companies. They are payroll companies. Now they pretend to do some HR, but they're really not. How do I know this? Well, because they don't guarantee that your overtime is paid. We have doctors in this dental society, who have called me saying that they are being not sued yet, but they've received letters from lawyers because they weren't paying their employees minimum wage. Now, how did that happen? Well, minimum wage went up in January, right? They were below that or at that number And so it went up. The payroll company never notified them that they were below minimum wage as of January. Like, so you have to remember, they are not payroll, they're not HR companies, they are just payroll, which is why it's super important to get HR compliant, because you need 12 to 18 documents minimum in California. There's actually 27 documents that we highly recommend to keep you compliant, but the 12 to 18 are minimums that you need to have. And if you go into your HR, portals, even, if you are with one of these payroll companies, you'll see it will be like a handful. It'll be like 4 or 5, right? Because again, they're not HR companies. So getting HR compliant is really important before you start selling. And the key is, if you are 1, 2, 3 years out, if you become HR compliant today, every day is one less day that they can sue you for, because the statute of limitations is 3 to 4 years, right? It's 3 to 4 years, okay? Hugely important. Here are some required forms. Employment application has been updated. Very important to have that, because a lot of information has been excluded from the employment applications that some of you may still have. The W-4, the I-9, updated in November. This is the immigration document. Hugely important to have, right? Sexual harassment information sheet, which says that you won't sexually harass your employees. If you're planning on sexually harassing your employees, just don't give them that one, okay? All right, just skip that one. Employment manual, right? Hugely important. Get an updated one, right? Get an updated one. It's super easy. HR for Health has one for free. They'll give it to you. They get updated every year, as laws change. An at-will acknowledgement, that they are at will. Again, hugely important, right? These are just some of the many that you're required to have. So please become HR compliant. The worst thing is to worry about this in retirement. No matter how much you think they're family, they are not your family, right? They will come after you for a year's worth of wages. Guaranteed. They will do that, okay? It's an entire year's of wages that they can get by just suing you, right? So unfortunately, it's very true. Okay, due diligence. The buyers will do due diligence on your practice. What that means is that they will do homework on your practice. Don't get offended, right? If they do this, it's Gavin's job to control that. But they will be doing due diligence. The first is financial due diligence. They're going to work with their bank, and they're going to work with their buyer's advocate or their CPA, and they're going to go through all your tax returns, all your balance sheets, everything, to make sure everything looks good. Then there's the legal due diligence. That's usually the part that I do for them, looking at the lease, the purchase contracts, your HR, right? If your HR is bad, we tell them to fix it all after they bought the practice. They will negotiate down your price. Honestly, if you have high HR violations, we see a lot more attrition. So the price will get negotiated down, which is another reason to get HR compliant. And then there's the third due diligence, which is practice management due diligence. This is where they hire a good consultant whose job is solely to do the analysis on the practice that you have, good or bad, right? Good or bad. Now, the good consultants will give them a report of the things they can do to improve your practice, okay? Now, you want them to do this third report, right? Because if they do this third due diligence, they can never come back to you and say, why didn't you tell me? Right? Why didn't you tell me about this? Why didn't you tell me about that? This is their homework. This is what they're supposed to do. So let them do it, right? The consultant will come in, either they'll do chart audits or they'll pull data from your practice management software. They'll have to give you NDAs and some other paperwork that they're not going to misuse the documents and the data they get, but let them do their homework, right? Don't be scared. Remember, just because you have a small practice, a medium practice, or a large practice, don't be scared. Every single one of your practices will sell. Gavin guarantees it. Okay? Right? Or your money back. Yeah. Yeah. Right? Every single one will sell. None of you will be left holding the bag. Why? Because you live in the greatest area, right, this state has to offer. And everybody wants to be here. Everybody wants to be here. And unlike the East Bay where I live, land doesn't grow in the peninsula, right? Right? Where I am, they just cut a mountain and they build homes, right? And then the mice start running around, right? That's what happens, right? And then we start getting closer to Tracy, and it's like, wow, I didn't know Tracy was so close. It's like, it wasn't close 5 years ago. But that's what happens. But land doesn't grow in the peninsula. It doesn't grow. So it's hard to be here. And so you have a piece of real estate that's really amazing. So every one of your practices will sell. Don't be scared about their practice management. You want them to find everything about your practice, because the more they know, the less fear they have. Right? Isn't that true for all of us? Right? What was the scariest time during COVID? It was when we didn't know what was happening. Right? And then we got the tests, and then we're like, oh, now we know who to shun. You know? Right? And then it was like, oh, okay, now we know more. And now we know more. And so it just became less and less risky, right? You know, I mean, a lot of you attended a lot of my webinars because we wanted to learn more, right? We wanted to know more because that reduces our fear. That's what happens here. The more they know, the less fear they have to buy. The less they know, the more fearful they are, right? Right? So just kind of keep that in mind. Let them do their due diligence. Don't be worried about it. All right. Final thing, lease negotiations. Please go home and look at your leases. When do they expire? As Gavin mentioned, we want leases. We want you to sell your practice towards the end of your lease, if possible, with 1 to 3 years left. And the reason is because in the Bay Area, actually in all of California, landlords will hold you accountable for the rest of your term, and then the buyer will be responsible for the rest or any term after that. Okay, so you will be on the hook if the buyer doesn't pay their rent or whatnot. So if your lease expires, let's say a year from now, and you're planning on selling 2 years from now, you need to move up your sale date, because I want you to sell it as close to when the lease expires. Let the buyer sign a new 5-year lease, 10-year lease, whatever. Okay, right? I don't want you to sign a 5-year lease and then sell that year, because then you're on the hook for those 5 years. Does that make sense? Right? So if you have trouble figuring out what your lease termination is, just email it to me. I'll look at it for free, and I'll let you know exactly when your lease is. I'll let you know when you have to notify the landlord if you want to renew, and all those details, so that you don't have to have that stress. You'll have my information at the end. Just email me and remind me we met here. Okay, DSOs. So DSOs have been sending letters. Many of you have received letters over the last couple of years. They're not sending letters anymore. And the reason a lot of them are not sending letters is because they are in bad shape, right? There are 27 that we know right now that are in financial trouble. Okay, there are many more that are in trouble that we haven't heard about yet. 3 have gone out of business. 1 had 130 offices. The other 2 had somewhere between 30 to 40, and then the last one had like 17 or so. So a lot of them are going out of business, and the reason they are going out of business is because they bought practices without really doing their due diligence, without really doing their homework. And so it's important for you to know that picking the right DSO to sell to, if you decide that you're going to sell to a DSO, is very important. There are still some really good ones out there, that are kicking butt, and they will continue to do well because they're very disciplined. They have really great leadership, and they're funded extremely well, and they've bought really good practices. And those folks who have sold to them are going to do amazing, right? They're going to do amazing. But a lot of the smaller ones that have been, built by like a hygienist and an RDA, those are not going to go anywhere, right? So there's a lot of those out there, right? So you just have to kind of keep in mind who you're getting in bed with if you decide that going the DSO route is the right way to go. Now, there's a bunch of different models, but I want to explain how it works with DSOs. So the way it works with DSOs is as Gavin mentioned, if you're buying a practice or if you're selling your practice, you should expect to get about 1.5 to 2.5 times your EBITDA, your profit, right? If you're normally selling your practice. When you sell to a DSO, you can get anywhere from 5 to 8 times. Okay, so much more potentially, right? Potentially much more. But there's a couple catches. One, they force you to work for them for at least 5 years, right? Minimum 3, but usually 5 years, right? So you must work back for 5 years. You cannot hire somebody else to work for you. It must be you, okay? That works for 3 to 5 years. The second catch is they don't give you all the money up front. They give you 60 to 80% upfront. The rest rolls over into the company, the larger umbrella company that bought you, okay? And the idea is that you are all part of this like partnership together, and that money that rolled over, when they go to sell in the future, because their whole business model is they pay you, let's say 5 times your EBITDA, and then a few years down the road, 3 to 5 years later, they sell for 10 times their EBITDA, right? And so they just kind of, they jumble all the practices and they sell it for a higher multiple. And so you will get your percentage of that second sale as well, right? Second sale. That's where the real big money and incentive is to sell to a DSO. It's not, you get a lot more, you get a lot of money up front, but you get you get to basically double your money the second time when they sell, if they sell, right? If they sell. That's where they're now. A lot of them right now are having trouble selling again because the markets have dried up with interest rates being higher, right? So really important to sell. You got to have at least $1 million practice. Please do not think about a DSO if you're collecting less than $1 million. The numbers just don't make any sense, right? The higher your production, which means the higher your profits, hopefully, the higher multiple you can get, right? The higher multiple you can get. But you got to go into it with real strategic advice. And here's the one mistake to avoid, okay? The biggest mistake I see with dentists selling to DSOs is this: sharing your financials with them, okay? What they do is they'll send you a letter saying, hey, we have a buyer, or we are the buyer. We're super interested. We've been watching you from a distance. You're amazing. To all 27,000 dentists, in the state, they send those kinds of letters. And they'll say, here's an NDA. As soon as you call them, here's an NDA. You're protected, doctor. An non-disclosure agreement. Send us your taxes. We'll give you an offer very quickly. And they will. They'll give you an offer very quickly. But why is that bad? Think back to what Gavin said. What is your practice valued on? On profit, right? On profit. What do your taxes show? Yeah, how you hide it. You're trying to hide your profits, correct? How many of you minimize your expenses and show the highest profit possible to the IRS? None of you, right? None of you, of course not. Your taxes are diametrically opposed to what you need to do to get the maximum value for your practice, because you're trying to minimize your taxes, which means maximize your expenses, minimize your profit to the IRS. That's why DSOs do this. They have this trick. They're like, send us your taxes, because immediately they're making money off of it, right? Because they're going to get rid of all that junk when they sell your practice later, which you'll benefit from, but upfront you're getting taken advantage of. So you should never, ever send your tax returns to the DSOs. If you are serious about selling a DSO, you need to talk, not to me, not initially, you talk to Gavin, right? Gavin, with his financial experience at the bank, will take your financials and basically prepare them to be given to a DSO, right? He will prepare them. He will take them, take out all the garbage, make sure it all looks good, and you add back all the things to maximize your revenue, maximize your profit, and then he will have you present that to the DSOs, and then he will negotiate it for you as well, right? That's the whole point. You got to fix your financials before you sell to a DSO. Never send it to them, right? Never send it to them, because then it's harder to negotiate with them later. Does that make sense? Right? So really important, really important. This is also important for non-DSO buyers, by the way, when you send stuff to the banks. But that's why, if you're not selling to a DSO, you should absolutely, use a broker like Gavin so that you can fix everything and then go to market, of course. But with DSOs, it's especially important because you would never send your financials to another dentist, but you will do that with a DSO, right? Which you won't after tonight. Okay. For those of you who haven't been taking notes, if you want to take note, if you want a copy of all the notes for tonight's presentation, feel free to scan that QR code. It says, I don't know if this actually will work with that little talking thing on the corner, but let's give it a try and see. There's a yellow little box pop up on the bottom of your screens. Yeah? No? No? Try again. See. You guys see that little yellow thing? No? Okay. What can we do about that? Can we? Oh, actually, you know what? Let me do this. Let me get out of this. Oh, now try it. Oh. Okay, now try it. Oh no, it went away. What did I do here? New share. Let me try this. Did it pop up? No. Okay. I don't know. What do you guys think? How can I get this back on? I just got out of the screen. It's like as soon as I got out of the thing, anyways, okay. While we look for that, any questions? Hold on. You know what? I think if I go like this, it'll come back on. Did it pop up? Oh, there we go. Okay, so let's try this again. Oh, there it is. Hurry, before. It worked? Okay, cool. Oh, it's very sensitive. That little box. Okay, great. So yeah, so I mean, you guys have all my info, of course, but here it is again. If you have any questions, feel free to email, call us. Gavin, I know if you want to come up here, if there's any questions for us, feel free to ask tonight. We're in a safe zone, so we can all chat freely. Yes.
Perhaps a conversation for another time, but I was just curious if you guys have the expertise to share your opinion on bringing an associate into the
Yeah. I mean, I think bringing on an associate, the right associate, to eventually have them buy in is a great option for a lot of practices. The key is finding that right associate, right? Because some associates, what they'll do is, of course, they'll come in, they'll see the patients, for a couple of years, so a bunch of turns, and then what do? They go down the street and open up their own office, and now they've, met all your patients, and yes, there's things we can do to protect against that, but the reality is that, like I mentioned, with California being the way it is, you can't really restrict them from opening up and doing what they do. So they can, they can't steal the charts, but they can send mailers, and people recognize who they are, they're going to come see, right? So I think if you're going to bring on an associate for the idea of selling to them, my recommendation would be test them out for no more than a year and then make a decision, right? Are they the one or are they not? And if they are, quickly move down the road of, planning for there to buy in or buy you out. Oh, yeah, I think if it's making revenue, if they're making revenue for you, or allowing you more freedom or whatnot, yeah, I think that's great. Yeah, associates can be wonderful.
HR help that
Mhm.
offers the services within HR for help to kind of guide that type of onboarding.
100%. Yeah, 100%. And when we would, the only people in an office that we would recommend giving a contract to, by the way, is the associate. Everyone else should be guided by the employment manual at HR for Health. But yes, to answer your question, yeah, if you're ready to hire an associate, whatnot, we can walk you through all of that.
And I think on the transition side, if I look at the employment roster and I see an associate, one of the questions I'm going to ask is, tell me about this associate. Have you offered to buy them the practice? What did they say? Sometimes it's like, this is a person that's very happy to work 2-3 days a week. They're just very happy in their role, and they will become part of the employment. But it can get a little complicated if the associate becomes a threat to the buyer, integrating with the patients, decides they want to leave. And so really want to be careful about really understanding the relationship that you have with that associate so that we can articulate that to the prospective buyer when it comes up.
Yeah. And guys, just to build on this, I mean, nobody asked this question, but I do want to say something about what I was saying about the DSOs increasing your profits. I mean, one of the reasons why, organizations like, the one that Tweenie, did I say it right? That that's so valuable for you is that you want to, as you're preparing to sell your practice, you want to get really smart about reducing some of the expenses that you have that aren't going to materially change your practice, right? Like, I wouldn't recommend cutting your marketing budget because marketing brings in patients and whatnot, right? Don't cut your website company. Don't cut HR for Health because you don't want liability there. But if you can buy supplies 10% cheaper, let's say, hypothetically, and I don't know what the exact numbers are, but let's say you buy supplies 10% cheaper, that's going to make a difference, right? That's going to make a difference because 10% of, let's say, $1 million practice could be an extra 50, 100K of extra profit that you get, which would go to your bottom line, which will increase your value, right? And so it's like these little things that are going to make a big difference, in terms of, increasing the value of your business. Any other questions? Yes.
Landlords.
Mm-hmm.
So I thought strategically, maybe I should renegotiate for options. Because that would hurt me right at the top of the.
Yeah.
Is that a good idea, or do you think?
Well, I mean, I think it's a good idea for you to have options so that if you have a hard time selling, you can stay there, right? But if those options typically don't transfer to the buyer. The landlord makes those options personal to you. Now, if you can get options that transfer to a buyer, that would be fantastic. It's very rare, but if you can do that, that would be great. But what I would say is if you're in that boat and you're like, well, I'm not ready to sell today, but I'm not ready to sell in 7 years either, right? Which would be your 2 years plus, let's say, a 5-year extension. I would start thinking about, planning to sell maybe in the next year when you have like 1 year left on your lease, because then you can sell. The buyer still can negotiate with the landlord and get a new lease. And if for some reason the landlord says no, you still have a year to figure out what to do.
And I think from my perspective on that, if you came to me and we talked, that's one of the first things I ask is tell me about what's left on your lease. And you'll say 1 year or 2 years. I know what the buyer needs, but I'm not going to tell you to go renegotiate and get yourself a new lease. We're just going to put that out there and say, okay, that's something that we're going to have to cross that bridge when the buyer comes in. And we're going to ask questions like, tell me about your relationship with the landlord. Have they offered you renewal options, or have they done anything that gets an idea of how responsive they're going to be? The redevelopment in there, I asked that question too.
Mm-hmm.
Tell me about the other tenants. What's been happening with them? Oh, they're all moving out. Well, okay. So, those are the things that we just kind of have to size up and put it in there. But ultimately what will happen is that we'll bring the buyer to the landlord to negotiate a new lease for that buyer. We just have to understand that your transaction is going to be contingent on them getting at least the term that the lender will support. So there is a risk there, but part of it is pulling that out up front and just understanding and building a plan around it.
I just learned something that you said that options in your lease don't transfer to the buyer.
Typically, yeah. Yeah, typically, yeah. Landlords typically want make those personal to the tenant because they don't know who the buyer is going to be, right? So they make it personal to you, and so the buyer has to just negotiate a new lease, new extension, new. Yeah, good question. Any other questions? No? All right. Well, thank you guys. Thanks for coming tonight. You have our information, so please reach out. Thank you.
Thank you.